Alright, it's been a while since I've done a video update on the blog here, but the oil market is in such an amazing position that I wanted to go over a whole lot of stuff with you in a relatively short period of time, so you can see what I'm looking at and why maybe what sounds a bit crazy that I've put on the blog the last few days, this idea that oil is going to make a dramatic decline here in the next few months, why that's sensible. This is a weekly oil continuous futures chart here. So this was the 2008 high. This was the early 2009 bear market low. This was the advance that happened since then. And there's a few things I want to look at here. The first I'm going to look at is the commitment of traders data. And what we've seen is on this advance since 2009, the smart money, the big money was selling or hedging a lot up at these highs here early in 2011. And then the market sold off here, and then as of mid-January, there's now been the first major sell in oil based off of that commitment of traders COT index data. The first major sell signal actually at a lower high compared to the top. So when you see the major selling happening in an uptrend at a new all-time high, it isn't that significant. That should happen as the market advances. However, when you see it at a lower high, the stage is now set for a big decline to come. You've kind of confirmed that there is potentially a downtrend starting because you're getting a lower high with a major psychological turning or selling point there. Now, what I want to look at is the pattern here, because this is really how I'm getting the specifics of where price is going to go. Let me start long term first so you can see kind of where I'm coming from, and then we'll go down to the short term. In the long term, this is a chart of long-term oil prices, and this is going back to 1980s. And what we had is basically the biggest commodity bull market in the history of commodities was the crude oil between 1999 here at $10 a barrel right here up to $147 a barrel in 2008. And I don't know how much anybody who's listening to this has studied the major bull markets of history, but when you see these major bull markets that some people would call manias or whatever, major speculative bubbles, there is always a huge bear market to follow. Typically, the bear markets are probably 90% from high to low decline. They very often retrace the entire bull market plus a little bit more. So while that sounds absurd, is the suggestion from the historical record of the major bubble type markets and manias is that this $10 a barrel low will probably actually be taken out before the next major bull market in gold. Now, with price close to 100 right now, that's a 90% decline, and I know that seems ridiculous, but you know, these things don't happen every day, they don't happen every year, they don't happen every decade, but you know, you see these type of moves throughout history, and there's no question about it, that is what happens historically. So what I'm going to do is, given that context, I'm not saying that's going to happen in a couple weeks or a couple months here, but longer term, that's the context we're in. I'm going to show you a shorter term pattern of why and what time frame this market is likely to move down. On the blog, I talk frequently about price logic, and I'm going to show you what I mean by that. So when I talk about price logic, what I'm talking about is how to identify where patterns actually end and start. And how we identify that is when there's a larger and faster, so when you have a move that is completely retraced in less time than it took to form, that's a good logical indication that a new psychological pattern is taking place. And what we've had since the 2009 lows in oil is this upward move trending up here. Then we had a larger, faster decline here, taking out these lows, indicating that the first phase move ended here. Then we had somewhat of a sideways channeling move to this point here, and then we had this explosive start of a new pattern. And that was right around the time this past spring where we heard news on Libya and Egypt and all this conflict out there. And I remember, going to the gym and hearing people in the gym talking about oil prices and stuff, and that's like a sure sign when the public is talking about that and they don't even know what a oil futures contract is. You're getting close to a high there. And so what we saw is this big spike up. Then we saw, in conjunction with the stock market, a slower retracement down to here, and then we've seen this move back up here. And how I would label this logically is what I would call an A wave, a B wave, and then a C wave of an upwards flat type of pattern. These lines here, this blue line, that's like the base channel line, and then this pink line is parallel to that, showing that there's a nice channel here where the C wave is about equal to the A wave in price there. Now, what's the projection on this? Here's the ideal time frame for this. When you have a short A wave and then a longer B wave that takes 2 or 3 times as long like this one did, the C wave will usually take around half the time. It'll usually top at around half the time as those two waves added together. And that's what these cycle, this 0, 1, 2, 3 indicates here, is I've divided the A plus B move into 2 parts here. And so the next cycle line will be half of the total of those two. And that cycle line basically came here in the last week or so. So we've now reached the ideal time frame for it to top. We've probably already seen the price high here a couple weeks ago. And we have some technical bearish divergence between this high and this high here. As far as what to expect to happen, let me show you what happened in stocks so you can get an understanding of how these things develop. This is the S&P 500. This is 2011 in here. And this is what happened this past spring, is in conjunction with that big move up in oil, we saw a big explosive move up in stock, starting a new pattern. What I said is, it looks like a new pattern starting. However, if this low here is broken, that indicates weakness, and possibly the pattern will complete at a lower high. Well, that's what we saw. We saw an upwards move, a longer downwards move, and then basically an A, B, C up to here. What we saw is a major commitment of traders data, smart money, sell signal here, just like we saw in crude oil here the past couple weeks. And what I said on the blog is that this C wave should be retraced in less time than it took to form. And then actually the trend line from here, from the start of the pattern to the low of the B wave, that trend line should actually be also broken in less time than the C wave took to form. Now that probably seemed ridiculous at that point in time. However, what we saw was that major decline during last summer, and that's really what is likely to happen here in oil. So if we click back over to that, we should really see this 0 or start of the pattern to the low of wave B, this trend line. We should actually see that taken out in less time than this C wave took to form. So I'll go over to a daily chart here. So what I've done in this red box here is shown that from this line here to this line here is the same amount of time as this C wave. So prior to the middle of April, we should actually see prices come down and break this blue trend line at $60, $68, $69 a barrel. Now, what I actually think is probably more likely to happen is we'll probably come out, we'll probably see the market take out the 2010 lows around this area on that move prior to any type of major counter trend rally. So I know that seems kind of outlandish, but given all the time factors, given the commitment of traders data, given the pattern, given a technical analysis, I believe that is what is likely to happen here. So here's what I'm basically looking at doing on the trading blog here. I've already recommended this is DTO. This is the double short crude oil futures. So I've already recommended buying DTO. We've got it right in here at where the green line is on this day here. So right around $40.30 or something, 39 cents, something like that. So we're already at a little bit of a gain there, and what we'll probably see is a pretty amazing move up here. And So that's what I'm going on as far as the trading block. What I'm looking at in options here is we have just a great setup for a really sharp move in oil. There's been somewhat of a distribution high since November. Relative to this high from last year in July, the market has once, twice, three times tried to take that high out, and it's been hit back every time. We've had this distribution type top where the smart money's been selling that top the whole time. You know, the smart money, those are the commercial hedgers. So these are the companies that are actually putting holes in the ground. They're actually getting oil out of the ground and putting it into barrels. They know better than anybody else in the world, in the universe, what it costs to actually get a barrel of oil out. And what they're telling us without any guessing or uncertain terms is that the price of oil right now is very high relative to the amount it costs them to produce oil. So they're really hedging their underlying business interest at these levels. Additionally, what we've had is, without going over the charts here, let me just click back to the long term for a second. You would think that at the top of this major bull market in oil here, where it went from $10 a barrel up to $150 a barrel, that you would see the peak in open interest or the long holdings of oil futures. You think you'd see it there. However, after this short-lived bear market and this rally, we've actually seen a bigger open interest accumulation of long oil contracts by speculative buyers, to a significant extent even higher than we saw in 2008. This is just so telling on the psychology, that the bull market psychology on oil from that biggest bull market in history has not left. It's actually just peaking out here over the past year, and the indication is we're going to see really a major historical decline back down probably below $10 a barrel. So that's the long term there. As far as the setup here is, you have this nice Bollinger Band squeeze, where the market has been channeling for the last month between here and between here. The lower band is starting to expand as the market has pulled back the last 2 days. The top band, what I like to see is for a nice volatile breakout move where the top band expands and then the lower band expands too, and the price closes below the lower Bollinger Band. When that happens, you see moves similar to what happened from here. The price broke below the lower band, the band's expanded. You see these sharp 1 to 2 week moves. You see a similar thing happen here. You see a similar thing happen here, here. We saw that in the same setup in stocks. In that pattern I showed you in late last July, the market came down, closed below the lower band. The bands were expanding. Then you saw this dramatic 1 to 2 week major sell-off. So I think that's the setup on oil here. I don't know that that's going to happen in the next couple weeks. We might have an initial decline, a rebound, and then a more major decline. But what I'm looking at is some options here. I already have one small option position, but what I'm going to do this morning is actually buy some more out-of-the-money put options. And here's what I'm going to do. What I'm going to do is I'm going to buy the April expiration. I'm actually going to buy the 30 strike puts on USO. Now that might seem kind of absurd to, when it's up around 37, to buy it 30, but going over everything I just showed you here, the projection is probably for price on this to go down to somewhere around 26, probably somewhere down in this level here. This is a weekly chart now I click to. So price will probably come down to somewhere around this 26 level by early to mid-April, based off of all that stuff we just went over. So right now the